Today on the show, we are talking a little bit about viability of side hustles. It's a bit of a property-themed episode, though, because we've got some questions about joint ventures and also selling your house to a developer. I'm with John Pigeon today, and John is from the This Is Property podcast. John, at what point, Sam asks, would you say a side hustle has viability? $1,000 a week, a certain number of sales, et cetera, et cetera. What are things to measure? So what are you telling Sam about their side hustle?
Well, first of all, it takes a bit of courage, doesn't it, to get a side hustle up and running? And I think a lot of us want to sort of dip our toes in the water without going full noise, let's run a business and quit our day job. I think I would look at it and say it's maybe got three levels. There's a level that says I'm earning enough money to run to cover the running costs of the business. Right now, depending on the type of business that is, as to how much that is. So yeah, maybe a certain number of sales, but it's got to cover the cost of doing things. Then you might get to that stage where it starts to give you some sort of income, as in over and above the running costs of the business. Again, putting a number on that is hard. It's very personal, but just going and targeting a figure there. And then the third one is really, well, hang on a minute. This has got real legs. I'm going to quit my day job, and this is actually what I do for a living. So that's the sky's the limit. Would be my thoughts on those, on how I'd approach it. But what do you reckon?
Yeah, I think number one, when you are asking questions like this in our Facebook group or you asking other people, you just can't pin it to a number because it's relative to your situation. But by all means, I think you've basically said it all, and I would just encourage Sam, about the viability. At what point would you say the side hustle has viability? What are you talking in terms of viability? Are you saying for me to keep doing this or for me to stop doing this and transition and do it full-time as my job?
Yeah.
And that just comes back to, well, if you're doing $1,000 a week, is that in top-line sales? And if that's the case, gosh, take some expenses off there. It's probably not viable for most people unless you live on a farm in the hills, you've got no rent, and you only need $500 a week to live off.
Running costs alone.
But that's all good, but it's not if it's a seasonal thing and you sell $1,000 a week with Christmas trinkets in December.
Yeah.
So I think I would just encourage Sam to step back, run the numbers to really see how much it costs, or more so how much you need to sell each week, and just work backwards. And I would start working backwards by, if you have an income, I'll make a number up, $80,000 at the moment in your own life, well, let's try and have the target of taking $80,000 a year. Let's have that as the baseline. Then let's add some of the costs.
Yeah. So
maybe we're projecting in this business, if we needed, we don't know what the business is, but assume it's 150 grand that we need to turn over to cover costs, divided by 52, that's just under 3 grand, 2,800 a week. But I think there is an important thing to note. You mentioned it in your third thing. Does this thing have legs? So it might not right now because you don't have the time to put into it.
No, and that's one question I was going to ask you is, how much is it passion and interest versus I want to make as much money as I can? Because a lot of these side hustles are passion driven, aren't they? I've got an interest in it, whilst others are really focused on, okay, I've seen a real opportunity here to make as much money as I can out of this.
Well, I think the making as much money as I can out of it isn't a good metric either.
No.
Because there's a lot of people that make good money and hate their job.
Yeah.
So I think it's a matter of, well, if it's something I want to do I like doing it? So at the moment, like my podcast was a hobby when I was in financial advice.
Yeah.
It was my outlet, playing around with the tech and all that. then I'm like, oh, I'm making a little bit of money from this.
Yeah.
I'm going to now, for me, it was viable because I saw the signs of life.
Yeah.
But the jump between your current thing and some viability that you may see or some signs of life, that jump there is basically the risk leap.
Yeah.
And there's no
courageous.
really good outcomes in this life unless you don't take some type of risk.
Well, you don't want to look back on it with regret and say, I should have pursued that.
No. But then when I quit the advice business and went full-time into the podcast, it started really doing better because I had the time. And unfortunately, I didn't have a hobby anymore. It was my full-time thing. And
Yeah, no choice.
We're recording on a Monday right now. Over the weekend, I was in here both days. I probably spent 4 hours in this room playing around with cameras and microphones and lights because that's a little bit of a hobby for me.
Yeah.
And I still like that tech side of it. So I don't know. I think Sam, just really work backwards and understand that you will have to take a risk, and that's pressing go at some point. And we don't want to do that right away. We do want to see some trends and, signs of life.
Yeah.
If you're selling Christmas trinkets or whatever and it's seasonal, maybe not viable, but we don't also know what the viability means in this little bit.
Good luck, Sam.
Good luck, Sam. Now, this podcast is brought to you by Sphere Home Loans. Did you know mortgage brokers are legally required to act in your best interest, and they must only recommend loans and lending that suits your situation? So if you go to Sphere Home Loans and, they've recommended Bank A or Lender A, well, they will have a rock solid reason why they recommended that to you. But I've seen the proposal documents anyway, and they will show other lenders in there. So it should become quite apparent to see what is best suited to you, because it's not necessarily about the interest rate. It's about, well, Sam's just started a side hustle. And even though, there's a better interest rate with banks C or B, they're not going to give you the 800K that you need, where this bank will meet that need. So it's appreciated that Sphere Home Loans have supported the show and helped hundreds of listeners out there. Until then, my name is Glenn James, and you are listening to Money, Money, Money with John Pigeon. Whoop, whoop. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11, or if you're just getting started. Let's get into it. Thank you so much for being here today. Okay, Kent, this is an interesting question or comment or discussion topic. Give some, save some, spend some. Sounds simple. So that's kind of my mantra in my life. I like to give some money, save some money, or invest, and spend some money in that order. But when you actually try to live it out intentionally rather than an afterthought, especially with mortgages, costs of living pressures, etc., particularly in cities like Sydney, the give some part raises questions that I'd be keen to hear others' thoughts on. So you can just search the Facebook group for this. 1, do you think about giving as a percentage of income, savings, or something else? 2, what feels sustainable for you over the long term? So when you are, in your job as kind of like the property coach dude, you would obviously have some broader chats around spending and saving and budgets and whatnot. What are you seeing out there from people? Are they givers? Are they not? How do you think you'd pluck this chicken?
Yeah, so I think the first part of it is you've got to get your own situation sorted first, right? Now, whether that's giving to others, giving to kids, giving to whoever, it's very hard to do that if you haven't got your ducks in a row. So that's the first part of it, and I'm sure Kent has. But knowing that the cost of living's gone up, the ability to save is becoming harder and harder. So I think there's never one version of this, but we've got to be comfortable in our own situation as to what we can give. Right now, whether it's $1, $10, or $100, or $1 million, it's the ability to think that we're helping someone else and not just looking after our own situation. So I think there's never one template for this, and I don't think a percentage that says you must give this away. I think it's just relative to your situation, your time in life. Is it just you? Is it you and your partner? Is it you with 3 kids? Is it you with a dog? Like, it's got to work for you, and you've got to be comfortable and content with that, because otherwise we're just sitting there comparing to someone else. That situation's totally irrelevant to us.
It reminds me of actually in the Quick Start Guide to Investing book, we talk about, setting your frameworks and foundations and whatnot. It reminds me of when someone rocks up and listens to this podcast for the first time and they want to sort their money out. It's actually really hard for them to read something that says you should invest 20% of your earnings and then do everything else.
Yeah.
I mean, that's cute because I've got my life going on and all that. It's easier for I think, Max, you've been talking about, becoming a man and getting a car and a job and all that stuff. It's easier for someone coming online for the very first time with a real budget to actually build in that habit and the behavior to say, from day one when I get paid, I'm saving or investing 20%.
That's right.
So I think we just need to chill out when people say, oh, you must give X amount or you must. This give some, save some, spend some. That's just what I do. Now, I'm not prescriptive with the amounts. So if, especially with mortgages, cost of living pressures, etc., particularly in Sydney, I mean, if your power bill's overdue, but you're giving $200 away a month to the John Pigeon Wildlife Foundation, I mean, what a scam.
Yeah,
but
and
also
credit card debt and everything else.
I think it has to be in you got to do things in the right order.
Yeah.
And if now is not the time to give financially, it's more of this intent posture for life. Don't be a taker, be a giver.
Yeah.
Now that could be giving blood. It could be cooking meals for a new mum or someone who's just had surgery, or Glenn James in Newcastle. Any of those examples. I mean,
it comes in all shapes and sizes. Doesn't it?
So I think I like how they've actually thought about this, because there is this thought of like, I would like to be a giver.
Yeah.
And different times can change, and you might, if you got $1,000 bonus or won $1,000 on a scratchy or something like that, well, you might say, well, any money that I get that comes in my door as a windfall that wasn't expected, we like to give 10% of that or 20% or I just really want, I just think it's all about balance in life, because if you're doing one of these things out of balance, it's not a good outcome.
No.
So if you're giving all your money away, you're neglecting your own house and your power bill and maybe what your kids need. If you're saving all your money or investing, well, you might not be enjoying the now or living in the now. You might be so focused on future you and squirreling money away, there's no joy there. But if you're spending all your money, well, you need to look after your future.
Yeah.
And also don't be so selfish and indulgent. Maybe you can help someone else.
Yeah,
so
balance.
I just thought it's a really good discussion point to talk about.
Reluctant to ask this question, but do you see a percentage there for giving? Like, do you say 5%, 10%? Like, because I contradict what we've both spoken about. But if someone like Kent's sitting there, is there actually a guide where you'd say, well, 5%'s good, 10%'s even better, like 20%'s the norm? Like, it's
Yeah, well, I don't know. I think, the Lord only asked for 10. So, that could be a good guide in someone's life.
Yeah. Because I feel 10's a good.
And you've got to realise most giving in Australia is tax deductible as well.
Yes.
So maybe you could pitch it as a 10 to start with. But I just think if the heart is there based on your situation, I don't think it's really that crazy to try and strive to I don't know, like you've heard about this effective altruism movement where have you heard of that? No. So Peter Singer was involved in it, Sam Harris, and all that. And it was basically like, I want to give to effective charities only. So Peter Singer's book, The Life You Can Save.
Yeah.
And don't at me, everyone, but his whole thing was like, it costs $5,000. This is an example similar to what he said, to train one guide dog to help one person who is short of sight and all that.
Yeah.
However, that $5,000 through the Fred Hollows Foundation could maybe stop 100 people going blind to start with.
Yeah.
I mean, he's a philosopher and all this stuff.
Yeah.
But I just think as long as you're intentional and the giving's effective.
Yes.
I've got the view I don't give to people wearing high-vis stuff outside the chemist or at Newcastle.
Knocking on your door.
Yeah. Or any of that stuff because I don't think that's effective because it's just my vibe. I said to one, I was leaving the chemist at Newcastle the other day and there was two people there. My first comment is when I was walking in the chemist, they tried to go me.
Yeah.
I'm like, oh no, don't worry, I'm poor. Like,
yeah.
I've got no money. Then on the way out, they're like, can we have a chat? I said, look, I don't want to be rude, but I'm not sure I like this charity needing two people paid to stand here to ask for money.
Yeah.
I don't know.
And I think a lot of people think, well, where is this money? Where does it end up?
Yeah.
Like in a lot of cases.
But just have some guiding principles, Kent, and maybe it is it'd be sweet one day as a household if we got our giving to 5% or 10%.
Yeah.
It doesn't have to be today.
No.
It doesn't even have to be prescriptive.
Yeah, still you're comfortable with.
Yeah, build it into your budget. So thank you so much for that, Kent. Okay, this one is really up your alley, Johnson. Magical Peapod, selling to developers. Has anyone got experience with selling to developers? We have a unit in Sydney and have been approached by developers who want to buy our block plus surrounding properties. It must be an older, maybe a little 6 unit or something like that.
Yeah.
They want us to enter into an option to buy within 3 years offer. So we need to decide would be happy to sell anytime within the next 3 years, which is a hard one. What else should we think about? I'd love to hear if anyone gone through this now and how it's turned out for them. John, before I get you to give your thoughts, I might just explain loosely for those to understand about these types of options.
Yeah.
So basically, the Magical Peapod, they've got a property and we'll call it worth $1 million, right? They write, and the developers would draw this up effectively, but they write an options contract to the developer that says over the next, so that's 1, 2, 3 years, over the next 3 years, this contract says that the developer has the option to buy your block over the next 3 years.
Yeah.
Okay. It's worth $1 million now. We know that if they purchased it, build apartments, that whole thing could be worth, we'll just call it 10 mil, right? We've got the option over the next 3 years to buy your block, not for the 1 million. They usually do a bit of juice in it for 1.7 million, for example. So basically what happens is if you enter into that, and sometimes they'll pay a premium on the option as well. So there could be, I don't know, $100,000 a year that comes in while the option's in play. And this is very this is the street smart guide to explaining how this stuff works. So if you're a property lawyer, don't at me just yet. So generally what happens is once that options contract is entered into, the developer has that option. They go and do all the work to submit to council to get a DA approved on this block. So they'll do surveying, they'll do plans, all that stuff, because if they can get the DA approved for that block is instantly worth more than the one now, more than the 1.7 that they'll give to the property holder. And it basically, and the reason why they do 3 years is because it could take 3 years for the developer to spend 100 or 200 or 300 grand in with councils to get all these DA sorted.
Yeah.
So then what happens in the perfect world, the developer comes in and has got the DA, so they can turn this little unit into a high-rise thing. The developer goes, sweet, we've got the option now to buy this, now that we can build on it. And if they couldn't get the DA up, the developer has just foregone the costs of the DA and all the planning stuff and potentially the premium that they've charged along the way.
Yeah.
So then if they do get it, they go, yeah, we'll call in the option to buy this property, give you the 1.7. Now, the reason that it's the 1.7 is because it's an amount that is higher than you could get for it just selling to the open market and without you going to get the DA and all that. The magical Peapod, they could effectively go and do all this DA work themselves or on behalf of the body corporate or whatever that is and do it all their work, but they're carrying all the risk. So if it doesn't get across the line, they might have wasted 300 to 500 grand on plans and planning and all that. So in a perfect world, it's not an out of the ordinary approach is what I wanted to say. And that's how, real property people, John, make money.
Yeah. Well, it's
not property people like you who buy and hold and carry all the risk and flip and all that. You write the option on it. That's how you make the money.
Yeah. There's it's risk reward. And in this situation, this person's got one unit and there's surrounding properties. It sounds as though there's a unit block complex. They want the option to purchase all of them plus the surrounding properties to do one big massive development that's going to, as you said, make a lot more profit than if it was just one unit. So, yeah, we've done a lot of knocking on doors over the journey to try and buy blocks that we think are appealing. And I think if I'm in this position for Magical Peapod, cool name, isn't it? We've got to be saying
Amy calls you, isn't it?
We've got to be saying, if this didn't come along, what are we doing with this unit? Are we holding it 10 years anyway, or were we going to sell it in the next couple of years anyway? Otherwise, okay, if that's the case, then we entertain that. But yeah, it's all in the developer's control because they can turn around and 12 months' time and say, no, we don't want to buy it anymore. But in most cases, once you commit to something like this, you can't sell it to anyone else.
And that's what I was going to say. They could turn around in 12 months when they've got a hard no. They've still got a covenant over the property.
That's right.
Unless you, and I'll speak to it, but you need to get your own property lawyer in to represent you on this.
Yeah.
Unless they kind of call the option and make it go away.
Yeah. So it can be really attractive, but you've just got to understand the pros and cons before signing, and a lawyer's a non-negotiable on that one, but knowing what your strategy is for that particular property.
But I think what else should we think about? I mean, it actually could be, I've been involved in the options contract world with property and made money and done all that, right? In an ecosystem, you do need the developers. I mean, don't get me started about unscrupulous ones that are idiots and do annoying, dumb stuff.
Yeah.
But it's a good part because you need someone that's going to take the risk to knock that down and build the 20-story building. So I do get it, and I've had personal experience and made money through this type of stuff before. I'm just saying, what else should we think about? Number one, like, could this be a way that maybe you could – because effectively, if they call the option, you will be selling it for more than what you could sell it for in normal market times, because otherwise you wouldn't go into the options contract.
Why would you do it? Yeah.
So when you go to a property lawyer, it's a developer, there's plenty of meat. Whatever they propose, it's going to be more because they're going to want to steal it.
You can negotiate. Yeah.
So it could be, upon signing, we want $200,000. I'm just making crap up off the bat because the counter side of it, and I don't think it would be there, is if in 3 years' time the option gets called and the market had moved, so we're now selling it to the developers for the 1.7 where we could have sold it in the free market for 2.3. Now, it's very unlikely, but that is a downside risk.
Yeah, and a lot can happen in 3 years too in terms of growth. But the first thing you would look at is, well, can I do this myself? Right? Have I got the team of people? Can I recruit the team of people to potentially do what this developer knocking on my door is wanting to do themselves? So that's the other part of it too, understanding people's risk profile around any of this. It might be just look, they've offered me $500,000 more than what I could get for it today, so I'm happy with that. I'll commit to it. But
so you probably just need to make sure that, and you could do some numbers assuming growth over the next 3 years could be X amount.
Yeah.
And a good property lawyer acting for you. That's all I would say in this. Yeah. Get someone who's just acting for you.
Yeah.
Because the developer will have the lawyers that do write the options contract that you effectively issue. You just don't want to get caught out.
And if it's something where you're living in, doesn't say whether it's an investment or not, but if you're living in it, obviously you've got to now go and find somewhere else to live. So when are you getting your money, and is there this holding pattern that you've sort of in no man's land for a little bit? So it's a commitment.
And I think the whole thing is there would be covenants. So if you did want to sell it within the 3 years, the developer has the first option to buy it.
Right, a refusal.
Or yes, you can sell it to another party knowing that there's an option in tow. And these are all the details that you just need to cross off. But not opposed to it, and it could be a way to actually get some money out of your property and not taking any risk. And the only risk you're taking is you're probably there for 3 years, and the market may be more than what you sell it for in 3 years. But you just want to make sure.
Let's hypothetically say, I'm just going to make some numbers up. There's 8 units in this complex.
Yep.
And let's say the developer wants a property either side.
Yes.
So there's maybe 10 entities.
Yes.
You don't want to be the first person to sign this agreement. You want to be the 10th.
So are you saying so when you said 8 units, are you talking on, just so we're very clear, there's 3 blocks.
Yeah.
2 Smith Street, 4 Smith Street, and 6 Smith Street.
Yes.
So you're saying 2 Smith Street has a freehold house.
Yes.
6 Smith Street
same
has a freehold house. 4 Smith Street, which you're in,
has 8 units.
And I will draw it for YouTube just so people can. So if this is Smith Street, I should have done this to start with. 2 Smith, 4 Smith, 6 Smith. There's a freehold property either side. And on 4 Smith Street, there's the unit complex, and this person maybe owns one of those units.
Yeah.
And then so there's going to be, you're going to have to engage the strata, the body corporate, to act on behalf of the strata plan here. But you're saying don't be the first lot to go into it. Or we say, well, we need a lawyer to collectively represent all 3, and then, I don't know.
You agree on a price together. But, traditionally what happens in these cases is, there's the 8 different entities in this example. There's 6 of them that the developer's got a concrete agreement with, and there's 2 remaining.
Yeah, but I think that wouldn't be the case because it would have to be the strata plan agreeing.
Yes. Well, that's where it comes down to
So there's only
having the
really
lawyer.
3 entities.
Yeah. So if they did have a say to say, well, hang on a minute, I'm just holding off to see how all this plays out.
Yeah. Well, but that's the thing. If it is what we've kind of drawn here as the example, if the purple, whatever it was, magical pea pod, if they're just an owner in one of these units, it actually doesn't matter. They need to just get quite informed and be informed to vote on it, yes or no, at a strata committee.
Have a majority.
And engage the committee to engage lawyers on behalf of the committee.
Yeah.
I'd imagine.
You just don't want to sell your soul too early is my
No, and that's what I said.
takeaway.
Like any first offers that they make, and there could actually be a lawyer that represents all 3.
Yeah.
Like the strata committee goes and talks to either side and go, hey, let's do this as a block.
Yeah.
Excuse the pun that they're blocks, but let's do it as an actual block. Yeah. Hey, we'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, Bright Kangaroo, what is up? Looking for some insight. This is another juicy one. I put an Instagram reel up on this the other day. I'm looking to buy my first home in Sydney, 1-bedroom apartment, and I went to an inspection of a property and that I liked, and I spoke to another owner of a unit in the block. She gave me a lot of insights into the building, which checked out, but then noted that the building would be going under some renovations soon as it was an old 60s building. Thinking new flooring, stairwell stuff, etc. She said that while the plans had not been finalised yet, the strata committee were looking at taking out a strata loan for the cost despite there being nearly $400,000 in the Capital Works Fund. That's so odd. She could not estimate how much it would be, as no plans of yet, but I noted as a single income owner, she was not too worried. I downloaded the strata report and got my conveyancer to have a look through, and there is no red flags, no mention of the plans. Knowing this information though, is it a huge red flag? Would you still consider this property? Any advice or insight welcomed? Far out. What are you saying to that one, Johnson?
Yeah, well, this person's only really spoken to the one owner, right?
Yes.
So we need to get more facts from the strata committee around what's happening there. It's unusual. Well, not unusual, but if they've got 400 in their sinking fund and they're wanting to loan money for renovations, it's going to be a lot more than $400,000.
Yeah.
So they don't want to run the well dry, which tells me that it's something substantial that's happening in there. So it is a red flag to me because you're like, okay, it's a 60s building. We all age. That's fine. But is there something underpinning that's actually going to cost a truckload of money here to be able to get done? And am I going to buy this unit and potentially be getting into dipping into my pocket straight away?
I think it's really important as a headline thing to say, if you're a first home buyer looking at apartments, because we talked about this all last year, my friend Ainsley trying to buy her apartment, I think we looked at 3 or 4 different documents and the amount, like, number one, there's apartments everywhere.
Yeah.
Number 2, the amount that have actually got crap financials or need work. I just think as a first home buyer, there's plenty of apartments, move on.
Yeah.
But I will say just some points that I was going to make. This whole thing comes down to like the number of units in the strata plan, right? Is there 4 or 400? Okay. Because the loan aside, so capital works and getting a loan for the capital works as opposed to raising a special levy, that's all part of strata living. And it could mean, depending on the type of work, it could mean that, based on each unit, there's only a special levy once off or ongoing of $10,000 a year for 2 years or something like that. Like relative to the unit allotment. So in strata, if there was, 10 buildings 10 units within the body corporate of different sizes, they'll have a percentage-based allotment, and that's what they have to pay based on. So, sure, there could be, number one, I'm moving on, but there could be a world that you live in where if you go and buy a building and there is documented capital works in tow with a documented special levy coming and it's $10,000 once off, well, you'd negotiate that into the purchase price potentially, and on the proviso that everything else was good and there was meat in the sinking fund. But the red flags, I think, are potentially – that's some big works. And do you want to be living in a place for a year with construction?
Yeah.
That's number one. So there's nothing in the AGM minutes. So the person that they spoke to, maybe a committee member, might not be. And often the committee might have had a meeting 2 months ago. And I know this being part of different strata things.
Yeah.
Like one of the properties I own, I'm the chair of the committee, like kill me. I got an email the other day from the New South Wales Strata Registry. Oh, the AGM hasn't happened for a year. And I'm like, what the hell's going on? Like the admin, when you pay the admin company to do it, you'll have the meeting and then because they're busy, you don't see the minutes for 3 months and like there's a bit of just admin time.
Yeah.
So the committee could have met for this meeting, engaged one person to get quotes organised. The minutes haven't been made and uploaded to the other members or on the portal or whatever. And they could also just be in investigation stages and it might not happen because
Well, the first thing is going to the agent saying, hey, why is the vendor selling? What's their reason for selling? And of course they won't always say, because there's capital works due.
Yeah.
But it's in most situations like this, the individual owners need to come up with their own funds, not the whole strata take on a loan as such. So that's the other thing that would need to be clear on there. But it might be just Mrs. Mangle gossiping about what's potentially in the building as well.
That was my third point. The person you spoke to could have no freaking idea of what's actually going on. They may have heard that, they're doing this. I'm not too worried. They said it. They just get it could just be all hearsay.
Yeah.
And I think my overarching comments would be, it's your first property. There's plenty of apartments. Move on.
Well, yeah, there's probably plenty of one-bedroom apartments floating around, and even though supply is low, it's I think there are other fish in the sea. If you line it up against other options at similar price, what are you getting?
But I'm not opposed to buying into so all other things being equal, if they find a one-bedroom apartment in a building, the strata fund's healthy, sweet, there is a capital works levy in tow. I think my biggest thing was until it's documented and baked in, that's gospel, don't entertain it. But if it's baked in that we've got to repaint the north side of the building, it's in plans, there will be a special levy of $5,000 a unit, that's happening. I'm not opposed to that because that's just part of life. It's just knowing and making sure that you're aware. I'm opposed if there's no money in the capital works fund, there's arrears and most of the building is investors only and the property owners haven't put any money into it because they don't care. And
yeah, I'd like to know how many is in the complex. But.
So, yeah, knowing this information, is it a huge red flag? I think based on what we know, probably walk. But would you consider this property? Not this one. Anyway,
well, I'd be doing some research to say what else is out there in comparison, internal square size, how many in the complex, location, and work out your per square metre rate that you're paying for something like this. And then you might find that, hang on, I can buy one up the road that hasn't got these perceived issues.
But that's wild that there's $400K of capital works, right? Now, one of the properties that I've got, we've just done a 10-year capital work. You get the surveyor out and they go, yeah, in 10 years' time, we're going to need to paint it at 60 grand or whatever that is, inflated to CPI and all that stuff. But 400 grand meet, and they're talking about a loan. Now, this is where the hearsay comes in. Is it a loan to cover the shortfall of 53 grand because the nature of the capital works means that they literally need some big deposits. Like the committee can't cash flow this through levies. So that's where the nuance is, well, no one actually knows what the friggin' hell's going on. And as nice as the person is that old mate spoke to, she could be misguided.
Yeah.
Or might not be. So that's what we just don't know. All right, John, this is right up your alley, this one. Brandon. G'day, folks. Hey, Brandon. I've heard John touch on JV, joint venture structures for acquiring investment properties before on the podcast. I'm not sure if they've done an episode on this. If they have, please link it and I'll give it a listen. Have you done episodes on JVs?
Yeah, on the property show.
Okay, yeah.
Yep.
But my question is around a JV, would the pre-setup phase be, i.e., what alignments to square away with other parties, goals, timeframes, legal parts to protect both sides, buyouts, etc.? And then also the practical parts. How does one go about drawing equity out to purchase further properties or even a PPOR?
Yeah.
In the very early stages of discussing this option, the other party would want to, if able, look at using equity in the next 3 to 5 years, 3 being ideal, but obviously no one has a crystal ball, blah, 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 blah. Many thanks, keen to hear. So maybe this could be just in finishing what are the 101s for a JV? And secondly, we might get you and Rach to answer this question over a half hour because
finance and
the finance it's going to, because you'd effectively have 2 separate mortgages and the one security. So
yeah. So trying to get it in some sort of order here. You're right, Brandon. Like goals, timeframes, legal, that all is extremely important. You need to be well aligned there with what your own individual goals are within the JV, but also your timeframes for the JV, because some JVs are development, let's get in, get out within 2 or 3 years. Others are long-term hold because I haven't got enough for a deposit to do it my own, or the servicing isn't suffice to buy what we want. So that's the first part of it. Why do we want to go into a JV? And then having those goals and timeframes aligned with legal involved to make sure the contract drawn up or the agreement is I suppose, tight, but also in agreeance to know that there's touch points along the way. Every 12 months we check in and say, right, we're still aligned, and what are our options if we're not aligned? And there's usually 1 or 2 or 3 options there to get out. One buys the other out, we both sell, et cetera, et cetera. The concern for me in this is 3 years, my mate or whoever it is needs to get their equity out. So 3 years comes along, we get a valuation done, and there's no equity. Now what?
Yeah, does old mate go, all right, I'm out, we're selling the bastard?
Yeah. And we've got to be happy with that. I think that's the worst case scenario. So they're the conversations that you have before you go and buy or find this property. The interesting thing about the finance is, and the structure is extremely important. So having a good conveyancer, a good lawyer in there, but also having a a great mortgage broker that's looking across the right lenders for this type of situation, because Glenn and I are going into a JV together. We both put in 100K
Can you
each.
believe we did that in the end after all these years?
Didn't even have an agreement. Anyway, I'm doing everything that you should be doing.
There
I
is.
know.
Yeah.
Yeah, it
took a while.
Yeah. Probably after the fact, to be honest. But any case, don't do what we did.
But we still did it. I want to be very clear. There is a buy-sell unit holder agreement for the unit trust.
And
we've all signed it.
Yeah, and we all know what the exit strategies are if there is one for any of them. So, yeah, that's key. I'm being a bit
naughty.
Yeah.
Yeah.
So
we've got a reputation, John.
The mortgage
bad,
broker, why the brokers important here is there are some lenders that will say, if you and I are in a JV together, and let's say we're 50% owners, which we normally would be, the broker the lenders will assess you as having 100% of the debt and 50% of the value. Now, what does that do to your servicing going forward?
What's the term for that? Joint and severably liable or something like that?
Something like that. But that is a massive issue, because when your JV partner wants to go and get equity out and they feel that they're with the wrong lender, there needs to be a refi, the vals come in low, they're backed into a corner, right? So you want a lender that's going to appreciate that Glenn owns 50% of the property and has only 50% of the debt, so it doesn't affect to essentially double his servicing or lack thereof. So, yeah, finance structure is a really big one, Brandon. So make sure you've got a sophisticated mortgage broker that does JVs and not JV as in husband and wife.
Yeah, I think the mechanics of this stuff is actually really easy, right? And just for completeness, joint and several liability is a legal principle where multiple parties are collectively, jointly, and individually, severally, responsible for the entire amount of the debt. So, yeah, sure, we went 50-50 and I lent and borrowed 500 grand of the million. I'm still liable for the million. So what you're saying there is that I might be governed with my servicing on the whole million because I'm joint and severally liable.
Where are some lenders that won't take the whole million? They'll take.
Okay, so that's going to be so key, isn't it, for strategy?
Massive. Yeah. But I would have, and I'm not turning you off this at all, Brandon, but sort of am. It's like, well, if your friend wants equity out in 3 years, what are you assessing that on, and how is that going to happen? What sort of growth do you need in this? And what's I'd be just doing a whole heap of new due diligence, which I'm sure you are, around the location, the historical growth, what's happening future-wise in terms of development and vacancies and a whole range of things.
I will say as well, the mechanics and all that, that's really easy and takes care of itself. It really does. It's the human relationship factor that absolutely just needs to be managed, and alignment must be there. I'm not doing something on the basis of old mate putting his life on needing the equity in 3 to 5 years. I don't know if you know this. One of the properties that we have together,
yes,
if there's a couple of unit holders, there's actually a relationship separation happening with one of the unit holders.
Right.
Now, it's not John, but I've talked to one of them and it's just like, all right, is this about to be everyone else's problem now?
Yeah.
So, I mean, but 2 years ago or whatever when we started,
it's all good.
It was all good.
Yeah.
But now it's like, oh, crap.
Yeah.
Are we all going to have to cough up money to buy someone out? Or
there's unknowns.
Yeah,
and there's unknowns in our own life, let alone
in
someone else's.
Yeah.
So when Brandon talks about drawing equity out, so simply equity can be drawn out as long as the servicing's there. And that's why that structure is important. But understanding, are we putting in cash deposits or are we putting in equity deposits? Because that's the other part of it. If we're loaning at 105%, using our own equity to get into this deal, then we've got to come from a long way back in order to be able to get equity back out to avoid LMI. So that's it's really important to spreadsheet that out and just know what your target is in order to get equity out in 3 years, and is that possible?
in finishing, I'm just drawing here for those who are watching, If the property was worth $1 million and it was 50-50 joint tenants, so each share gets carved off to whatever's estate in the event of death, and it's literally tenancy of 50-50. If one party had $500K that they put in and purchased their half, the other party only had $100K and they borrowed the $400K.
Yeah.
Does that make sense?
Yeah.
So they're responsible for those repayments. They've got to make sure that their lender isn't saying, well, no, there's no other debt. But that wasn't my point. What you're saying, with the right structure, old mate on this side who owns his $500K outright, old mate here has $500K of equity. Do we live in a world where old mate could get a $200K loan secured against his portion to invest elsewhere? Is that what we're saying?
No. We're looking at the whole.
But then you can't get equity out.
So we're living in a world where that property is owned by, again, Glenn and John.
Yeah.
Glenn wants to get equity out.
No, I guess I'm saying, can I secure, because the part that I put in, there was $500K of cash that I put in.
Okay.
You've got a mortgage, all that.
Yeah.
We own 50-50. I want to go and buy some equities and gear up into $200K of shares with a loan, and I want to secure that loan against my half. Because if I own the whole thing, that would be possible. But are you saying because it's split, you can't?
No, you can pull equity out, but it adds to the total loan against the value of the property.
Yes. So if that happened, you over here who put $100K in and have a $400K mortgage, next year when you go get a mortgage, the lender at the time could say, well, John, no, we need to assess you not just on the 400, but the 200 that Glenny boy
it's already
drawed.
taken out, correct.
Yeah. So, it's all things are, everything's possible.
Yeah.
You just got to make sure the ducks are lined up.
Yeah, and just know the person that you're going into a JV with, you've got clear expectations and you're on the same page and you have regular check-ins.
Well then, thank you so much for listening today. It's been great to have you. Thank you for your patience while we, try and do the best show that we can for the people out there, and we really appreciate it. If you are watching this on YouTube, I know a lot of you don't subscribe. That's fine. Don't subscribe. What about just giving us a like? Give us a little thumbs up. We're just trying to grow the YouTube channel. I'm putting a lot of effort into this. It's a different audience than the listeners, and I'll always be aware that there are audio-only listeners. But, just thank you so much for all your support, everyone. And, we'll leave it there. John Pigeon from This Is Property. Thanks so much for today. Bye.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glenn James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.